Hello, ladies and gentlemen, crypto deep divers. Welcome back to Weekly Crypto. Today, I'm going to talk about the home prices, and I will touch on the inverted yield curve. I talk about inverted yield curve probably in my previous video. You can also check it out. And just in case you're new to the channel, you can earn EOS, Lumen, Coinbase in Coinbase, and as well as DAI token, basic attention token in Coinbase as well. And if you haven't installed the Brave browser, you can click the link below. And this saved me time for surfing the internet and block out all the advertising. So let's talk about the home prices. So they're talking about the home prices probably go downhill from here. And this is not surprise because with the negative interest rate and easy money policy, and basically the negative interest rate is metastasizing across the world, and central bankers basically resuming the quantitative easing, basically massive money printing. And they are just basically printing money out of thin air. Those easy money policy pump up the stock market, the real estate market, and of course trillions and trillions of dollars are injecting into the world economy. And this is supposed to be a temporary measure after the financial collapse on 2008, and yet they never stopped the rewinding the QE. They keep on doing it for almost a decade. So if you are the retirees, the saver, if you put money in the bank, you probably get zero interest. And but if you put your money in the stock market or real estate, probably your asset is more than double by now. And also the cost of living has been exploded, but the wages have been stagnant. And companies, they try to do automation, and of course they reward the executive by doing automation, but then at the same time, unfortunately, eliminate a lot of blue collar jobs. Of course, the executive get bonuses, help the company save money, cutting costs and everything. And with automation, you're just dealing with the robot and all that. You don't have to give them healthcare. You don't have to dealing with strike or something like that, right? Automation is easy. I mean, you're just dealing with a robot. They're running 24/7. They don't need to take breaks or whatnot. So artificial intelligence, I talked about that in my previous video as well. That will take away a lot of jobs as well in the future. A lot of things like AI can take over. For example, some hotels in Japan, they're using an AI as a receptionist. And also, of course, when you call the call center, a lot of things already automated. A lot of things have been AI as well. And right now, we are in the widest wealth gap in US history, and it is worsening. So there's a huge difference, the poor getting poorer, the rich getting richer because of this easy money policy. And of course, the central banker, they still doing what they know this isn't working. They just pump up the asset, and this doesn't really, helping the economy fundamentally. And I think yesterday, Mario Draghi from the ECB, they announced another stimulus. So this is not just double down. They want to triple down all the stimulus, this easy money policy. And you can see the high risk of world money supply is increasing. And basically, it devaluates your money in the bank because of the inflation and all that. And of course, if you're owning some of the inflation-adjusted income stream, for example, you are the landlord, you have rental properties, you can increase your rent. And of course, you have farmland or profitable business, mining companies. Then you have inflation adjustable income stream. Otherwise, if you're the saver or you're just working with a regular job, no asset or nothing, your money in the bank is basically wiped out by inflation. So the $100 today, tomorrow may worth less than $100, maybe worth like less. So the purchasing power has been declining because they have keep on printing all this money. And so basically, so also deflationary correction also will also because inflation curve doesn't go from straight line from here. There's also a deflationary correction as well. And this will open the opportunity. For example, real estate. Real estate starting have a new correction right now. And because the housing prices are so expensive, no matter how low the interest rate go, the average household cannot afford to buy. For example, in San Francisco area, San Jose, Boulder, those are Colorado, those are the very red hot US housing market are now cooling off. Usually, during the summer season is one of the hottest seasons for selling a real estate, July to August. And usually you can sell good price during those times. But now there's an unusual price drop from July to August. So this is the largest summer decline since last year. And and of course, also the home construction is also plummeting in those areas. For example, San Diego, they just report there was a 43% fewer homes built in Q1 to 2019 than last year. And of course, which is Southern California, they fell 25% for the home construction as well. And affordability is a huge issue in San Francisco area because the wages growth has been anemic, since the Great Depression. And U.S. household debt is also increasing. And you have, of course, the biggest chunk of your the debt is from the mortgage, and then you have a HELOC, which is the home equity line of credit, and auto loan, credit card debt, student loan as well. And this has been piling up the debt. The total debt has been household debt is at the highest level right now. And in terms of the housing prices, right now it already surpassed the 2007 bubble price already. So this is based on the Robert Schilling, Case-Shilling Home Price Index. And I mean, you wouldn't be surprised that the house prices will start falling. And also there's a fear factor because, CNBC, those mainstream media talk about the inverted yield curve. And then even all this mainstream media, talk about it. And then this caught the attention of the average Joe that there's an upcoming recession coming up. And this is based on a recent ABC News poll showing that 60% of the Americans believe recession is coming ahead. So they are not willing to pay higher prices for the houses compared to probably 1 or 2 years ago. 1 or 2 years is a seller's market for the housing prices, and then people are bidding for the houses and people are fighting for the houses. You have multiple bid for the house. But right now is basically, I think, is not a seller's market anymore, depending on the location. A lot of market become neutral, and some areas are buyer's market too. And of course, the marginal capital flow. And back in like 2 to 3, probably 3 to 4 years ago, you have a lot of foreigners buying the houses in US, like Russian money, money from China. They're buying up real estate in US, in Canada, in Australia. So there's like a lot of capital outflow from China. But right now, China, they have tightened their capital outflow. So they have capital control as well as the trade war. There's a lot of tension. And now it's a little bit difficult to get the money out compared to 3 or 4 years ago in China. And you can still get it out, with connections and everything. But the thing is, right now it's tightened, not like used to be. They can throw out tons of money. I mean, those money probably from corruption, from a lot of from a lot of corruption, or they make huge profit from corruption probably. And those government officials, they want to buy the houses for their kids in the US, in Canada, or in Australia, and they have tons of money going out from China during that time. But right now, no more. So I think China is also facing an economic problem coming up because the economy has been slowed down. So, and as well as the trade war, a lot of factory is going to, I think a lot of factory probably move out of China. They will go to Malaysia, go to Vietnam, go to Thailand. There's no advantage in China anymore because of the tariffs. So that will affect the jobs, the factory jobs in China. That will be a huge consequences because there's a lot of migrant workers. They move from the rural areas to the city, work in those factory jobs. But right now, I don't think I think there's a shutdown in factory as well in China. So, and Of course, based on the data from April 2018 and March 2019, the value of U.S. home purchased by foreigners dropped 36% from 121 billion to 78 billion. And used to be, I think, in Australia, even a foreigners can get a mortgage. Yeah, they give out mortgage to them, and then it like I think Sydney, they have a housing bubble in Sydney, and I think the price is going downhill probably in the last 6 or 12 months. I think the bubble is already bursting in Australia because of the dry up. Those foreign money capital is already dry up basically. So we looks like we are looking for we are going to the housing market because of the last 10 years has been keep on going up and up. So I don't think even the stock market this is a long stretch of the bull market. For the stock market is like 10 years. I think the cycle is like every 7 or 8 years. I think 10 years is a long stretch, seriously. So here they're talking about, hey, are you going to prepare for the next downturn? Are you going to have enough have extra money to buy up those cheap assets? Just like 2008, after the financial crisis, nobody want to buy, and there's a blood in the street. When there's blood in the street, are you going to buy or are you going to sell? So are you going to plan ahead? What are you going to do in the future? Are you planning to sell some of your property or whatever to plan for the next downturn? So let me know what you think. Please comment below. How are you going to prepare for the next downturn cycle? I would love to hear from you. And another interesting thing, they talk about BlackRock. BlackRock basically is an asset management company. They hold around 24 trillion worth of properties, and they intended to double that amount over the next 5 years. Yeah, if I have a big firm like that, if there's next financial collapse, I will buy stuff too if I have money. So let me know what you think about the next housing downturn. Are you going to be prepared and position yourself to scoop up some cheap asset in the next cycle? So the next stop, we're going to talk about the inverted yield curve. So I talked about the inverted yield curve in my previous video. You can check it out. So basically, right now, the 2-year, this is the spread between the 2-year note and 10-year note. So it's go to the negative territory. So that was the negative territory back in, I think it's August. Oops. I think it's August. In August, I think the end of August, I think around August 28, it's in the negative territory. So basically, the short-term interest rate is higher than the long-term interest rate. It doesn't make sense, right? So if I loan you money and get for the terms is 2 years versus 10 years, I get more interest rate in 2 years versus 10 years. It doesn't make sense because the longer time you loan out the money, you should get more interest rate. But this is now, that's why you call it inverted. The short-term interest rate is higher than the long-term interest rate. So the 2-year note interest rate is higher than the 10-year treasury. So back in 2005, the curve was inverted back in, I think in December 2005. So December 2005, which is the financial collapse is around, I think it's around starting on December 2008, the financial crisis. The stock market is at the peak probably on November 2007. Let's go take a look. So the curve was inverted in 2005 December, and it takes almost 24 months before the stock market collapse. So you can see, I think they go to the stock market at the peak probably around October 2007. Ever since then it will go starting to have a huge correction, and of course it will have a big collapse in back in 2008 and 2009. So you can see that even though the curve is inverted in August 2019, we just have an inverted yield curve. It doesn't mean that we are going to have a financial collapse the next day or tomorrow. It takes about probably 6 months to 24 months before we are going to have a next financial downturn. So this is based on historical data. Every time you have an inverted yield curve, you can see this is negative. All this based on all this historical data with an inverted yield curve. It takes about 6 months to 21 months before we have a financial downturn or financial collapse. So last time is in December 2005. It takes almost 2 years to have the financial collapse in 2008. So it could be longer, it could be shorter. We don't know. We don't know the time frame, but the curve was already inverted back in August, I think August 28, 2019. So it probably takes about maybe 6 months to 24 months before we see a financial collapse. So nobody have a crystal ball. So in order to push it, but the thing is, even though you have an inverted yield curve, the stock market keep going up, okay? Before it finally, at the peak at October 27, 2007, and then finally collapsed. So you can still get a free ride from now to the peak, but you never know. So not a financial advice. You do whatever you want. I'm not a financial advisor. You decide what you want to do. Maybe you still can get a free ride during this time. 2005, they're inverted, and then it takes almost about 2 years. Maybe it could go faster, maybe it go slower. We don't know. And then 2007, the stock market is still pumping up. And before you have financial collapse, I remember one of my friend. He sold all his stock in 2005, and then converted to gold and silver. And at the time, 2005 and 2006, you are at the very hottest. Everybody's buying real estate, flipping real estate. The market is in great prosperity. Everybody is laughing at him, saying that you're so stupid why you sell all your stock into gold and silver. And yet, and he basically protect his asset in 2007 after the collapse. Remember, the gold and silver went up to gold went up all the way almost 2000, right? I think after the financial collapse, they don't increase right away, but they increase gradually, maybe and so I don't know. So it's up to you how you protect your asset the next upcoming downturn. And I could be wrong too. Maybe it's just different this time. Maybe this bull market can go on forever, infinity, because of the easy money policy. Nobody have a crystal ball. So I'm not a financial advisor, just FYI, not a financial advice. You use your due diligence to determine how you put your money. I'm not responsible for your loss. So this is just for entertainment purposes and for your information only. So if you let me know what you think about the inverted yield curve, the upcoming financial downturn or potential financial collapse, and there will be a lot of black swan event coming up too. Hong Kong is also another black swan event with the prolonged protests in Hong Kong. So you never know. So let me know what you think about this inverted yield curve. Do you think this time is different, or do you think the inverted yield curve will give you a signal for the next downturn in probably 6 to 24 months? So we don't know. And based on historical data, this has been saying that inverted yield curve showing that the next downturn in 6 to 24 months. Please comment below. I would love to hear from you. If you found this video helpful, smash the like button, subscribe to my channel. Also share with your friends. Make sure you subscribe so you don't miss out the upcoming airdrop of giveaway. Please comment below. I do respond to your comment. I would love to hear what you said about this inverted yield curve, and as well as the home prices. And if you have already subscribed, make sure you hit the notification bell so you don't miss out the upcoming airdrop or token swap. Remember, crypto deep divers, we the people take control of our money. Stay wise, stay safe, peace. I'm not a financial advisor investing in cryptocurrency or stock market or commodities can have inherent risk. Please use your due diligence. I'm not responsible for your loss or gain. You have to use your due diligence for your investment. And